It seems like, recession risks are building. You hear this first acknowledgement from Jay Powell that maybe it is imminent. Should I believe what he says? How much weight does his words have?
I think definitely if you look at what's happening in the economy right now, given the elevated inflation and the Fed needs to tighten further to contain it, we're definitely seeing recession risk being more elevated, even though in the near term we think the strength of the household as well as corporate balance sheets could contain some of that risks, but definitely more of a problem next year.
Yeah, I mean, you've gone underweight equities, haven't you? So, where are you seeing opportunities elsewhere?
Yeah, so currently, given our expectation of growth being maybe subtrend at the start of next year and also inflation being elevated, we think there's definitely more downside risks to both earnings and margins. So we have moved underweight to equities. So currently, we have an overweight stance on cash. We just think in the current environment, a defensive position probably is the right one.
So you're saying we might not see an recession this year, but you're saying an earnings recession is very much in focus now.
Yes. So even though that a full-blown economic recession is plausible, not our base case at the moment, but if you think about where growth is going and also the fact we have higher labor costs and higher commodities costs, that's likely to weigh on margins and earnings.
Yeah, this is an earnings growth like to be nothing like what we've seen, and that's the point. And how much of that is now priced in your view? And what else is the market pricing in on top of that? Because they're perhaps looking at an earnings recession rather than perhaps an economic recession.
So definitely we think some of that weakness in earnings is already in the price. But if we are heading to an economic recession, we think there's more room for equities to fall from here.
I'm just taking a look at the year-to-date performance. We were just showing a chart on just cross assets, right? If you rank the best to the worst, it really was energy, oil, you have the dollar, then you have the likes of, gold, and then you get lower to that, it's basically 10-year treasuries and then the S&P. Is there anything that could change this narrative for the rest of the year? Do you think that anything could shift?
I think if we are looking for an environment where growth is cooling but inflation remains elevated, that ranking is unlikely to change. We still think commodities probably will do relatively better in this environment. In the middle, we'll have the fixed income assets, and right at the bottom would be equities.
You think commodities can still outperform given the recession risks that are building right now?
We think there's still, if you look at the commodities market, especially the oil products markets, that inventory is still relatively low. So there is still room for it to move higher if we do have a squeeze more on the supply side.
Yeah, and with all that said and what you said in terms of the economic conditions, I mean, they're applicable to quite a lot of the world, but not to China. So you must have, of course, a different strategy there. And I notice that you are getting more and more positive on Chinese equities and perhaps even a little bit more on tech as well, of course. That's the big one.
Yeah, so we're definitely moving more constructive on Chinese equities. We think that in the environment where global growth is slowing, we're seeing China's economic cycle as well as policy cycle moving in the other direction. And also recently, we're just seeing more positive, more dovish stance from the policymakers on the tech sector as well. We think that could be a support.
Constructive, what would it take to be full out bullish at this point? Does the housing market have to come back in a meaningful way for you to turn a little bit more optimistic on China?
I think to turn more optimistic, we probably need to see a more meaningful shift in the COVID policy stance that would really release some of the pent-up demand we've seen in consumption.
What about credit?
Credit overall, if we look at the U.S., we're turning more cautious there. We think that current spread levels are not that attractive given elevated recession risks. But on a relative basis, where we're seeing potential of heading into a recession, we do prefer the higher quality assets. So on a relative basis, we like investment grade to high yield to equities.
If I think a recession is probable now, do I think that we've seen a peak when it comes to U.S. Treasury yields?
I think there's definitely more two-side risks right now. So there's still room for it to move higher if we see higher inflation prints coming through, more hawkish Fed. But definitely as growth concerns take hold, we could see it move lower from here.